back to the latest episode of Unscripted, a LeaseLock podcast. My guest today is Jay Parsons, a leading rental housing economist, a partner in Waymaker, and someone I have counted as a friend for over a decade now. Jay is known for building an audience second to none in multifamily and being a voice of reason when reason is often abandoned, if we're being truthful. And with a viewpoint as broad as Jay possesses on the industry, we really could have taken this conversation anywhere rental housing, but I wanted to focus in on one particular challenge that the industry is facing and one he's passionate about as well, and that's the villainization of the renting public. See, as the industry continues to face ongoing scrutiny around operational practices and corporate ownership in quotation marks, there's a group of unintended victims in these debates, the renters themselves. Now, I'm not going to give too much away, but we get into just how bad this is for rental housing in general, as well as the various constituents we serve, and I hope it can serve as a bit of an eye-opening and a call to action for the rest of us in the industry. Rental housing is a valuable and necessary service to the American people, and we need to make sure those of us on the inside are not exacerbating the perception problem, something we talked a lot about in the episode. But before we dive in, just a reminder that the views and opinions expressed in this podcast are those of the individual hosts and guests and do not necessarily reflect the official policy or position of LeaseLock. The content is intended for general informational purposes only and should not be construed as professional advice or endorsements. While we strive to ensure all the content is as accurate and up-to-date as possible, LeaseLock makes no representations or warranties of any kind, expressed or implied, regarding the accuracy, completeness, or reliability of the information discussed. The content is provided as is, and LeaseLock assumes no responsibility for any errors or omissions. Listeners should consult with qualified professionals before making any decisions based on the content of this podcast. This podcast may include references to third-party sources, which are provided for convenience and informational purposes only. LeaseLock does not endorse or take responsibility for the accuracy or reliability of any third-party content. In no event shall LeaseLock, its affiliates, or any of its employees, officers, or agents be liable for direct, indirect, incidental, special, or consequential damages arising out of or in conjunction with the use or the reliance of the content of this podcast. Now, with the highly scripted disclaimer out of the way, let's get unscripted with Jay Parsons.
Jay, it's a pleasure having you on the podcast. Welcome.
Thanks for having me. I'm excited.
Absolutely. It feels a little bit like old times to me.
We've done this many times together.
Yes. It was interesting. I was thinking about this as I was thinking, okay, I'm going to lead this conversation, which is the opposite of the way we've done this most of the times, where we bounce back and forth.
But probably better this way.
We'll get through it. Well, I want to start with a question that I think pretty much all of multifamily wants to know the answer to. What's it like being the most popular multifamily guy on LinkedIn?
I'd rather be the most popular person, probably somewhere more important than LinkedIn. But no, it's LinkedIn's been an amazing platform just to build relationships. And I started posting during COVID just to people who seemed hungry for information, gave it a channel to connect with people, and it's been amazing. And it sounds kind of cliche to say, but it's been amazing how many doors it's opened just to getting to know people. And I learn more. People comment a lot of times either online or offline, and makes me better at what I do as a result. So it's been a lot of fun.
Yeah, it's been interesting. I've had a couple different folks who've reached out over the different years recently, and I'm like, well, how to become more of an influence on LinkedIn, how to use it more for your platform, and actually even more importantly, it's like, how do I learn about multifamily? What are your sources? And one of the things I always tell them is to follow you. And it's honestly as much because of the commentary that happens in your comment section as it is the daily prolification that you put out there. You should put some out Monday through Friday that has meat to it, not just, here's the picture of me in my office as my lights went out like I did last night.
That was a good post, though. No, you're right. The comments are make it rewarding. If no one commented, they just hit a like button. I don't think I would do it as much.
Yeah, and you're fantastic about engaging in it. And one of the things there was a reason I started with that, because one of the things that I've noticed as you've been more and more prolific and more intuiting on some of the things that there are issues in the industry, is one of the things that you've focused in a lot on is the need for affordable housing. They have the little a as well as the big A. And one of the things that I've also seen you expand on, and correct me if I'm wrong on this, or just comment, is like you've, and I think I stole this term from you, so if I didn't, correct me. You've really also kind of, maybe not focused in on, but you point out when someone is like vilifying rental housing or vilifying the renter.
Yeah. Absolutely. No, I think a lot of the attacks around rental housing are really attacks on renters. A lot of times, especially when I post on SFR, I mean, the stuff people say with their names on it is wild.
Yeah.
It's like, wait, I think about what you're saying. You're saying that these are second-class citizens who shouldn't be living in your neighborhood. So then you kind of push the point, and I probably shouldn't push people as much as I do, but I'm like, I get fired up. It's like, guys, like, this is discrimination. Like rentals help diversify neighborhoods, people who couldn't otherwise afford to live there. So yeah, I think it's that's a whole can of worms. But it's rental housing is important to the fabric of our country, and there's a lot of hostility toward renters and rental housing. And you and I would, in our previous employer, we had a survey that Jason Dorsey did that showed that renters feel that way too. And that's always stuck with me, and I feel like that's an important thing to call out.
Well, I think it's important. I agree with you, and there's an entire narrative around the American dream.
Yeah.
And the American dream focuses in on home ownership and building wealth through home ownership. And whether you're a renter by choice or a renter by necessity, that's not a vehicle you're taking advantage of at that point, right? And again, maybe I'll be crucified for this one, but it's not something I think you have to necessarily have. There are other ways to have those same types of returns in today's society.
Well, and I tell people too, it's a both and, not an either or.
That's a good point.
Everyone's always about like, if we build a rental, that costs a for sale home. That's not true. That's not how math works. And you can do both, and both can be successful. Renters should have rights to live in nice neighborhoods, even if they can't afford or don't want, for whatever reason, to buy there for the time being. So, and we can support rental housing also without, attacking for sale housing.
You bring up a really good point of the idea of every opportunity that isn't a single family home is degrading a neighborhood, and you see that a lot, obviously, with NIMBYism that happens on these. And it's been interesting to see really NMHC and NAA really step up to the plate as far as increasing the amount of advocacy that they're really bringing the industry in. And I think that one of the vehicles that you use from that is your public voice on LinkedIn. So
yeah, and it's that's one of the things I think it's important to point out. I probably do a better job also of there is a lot of good coverage, and I think it's tough being a reporter and tracking these things, and I don't want to be just a media hater, but it's important to get some of the facts out there too. And there was one recently where, kind of a macroeconomist was quoted basically implying that by building build-to-rent homes, we're taking away for sale inventory, and that was demonstrably false. And one of the primary builders that was referenced in the article was Avalon Bay, which is an apartment builder. Like they're choosing to build BTR instead of apartments, not instead of single-family homes that people could buy.
Well, and that is a space that, I guess, because it is so relatively new and because it is so still fragmented, is, what is BTR? If you go to a single family home builder, a BTR is a home that was built in a neighborhood of for sale that is built specifically with the intent of renting. We used to call those spec homes before we actually sold them off. The BTR you're referring to, and I actually experienced and lived in, is that dedicated community that from day one, every intention was to deliver more rental homes to the market that just happened to be single detached or townhome style construction.
And they couldn't sell those individually if they wanted to. They're having to get, rezoned, replatted, and all that stuff.
Yeah. And yes, and although I would love to see some builders out there actually figure out a way to make the economics of something like that from a single family perspective actually work, because again, having lived in one, the horizontal apartment in Monaco, at least in the one I was in, is the perfect description for it. Yeah, that's really the way it lived too.
Yeah, it's just gotten so hard to build. I mean, again, I'm a both and guy. I wish we could do more. One of the comments I get a lot over social media is, "Hey, why don't we have more condos and townhomes for purchase?" And there's a lot of reasons for it, but the it's challenging. Like it just doesn't work, and unfortunately, that we've not been able to build a lot of it. But again, people who need that type of unit, thankfully, we do have lease an option through rental.
Obviously, we do have a shortfall of housing, and I love the estimates that you see because I love the range that you see. Yeah, anywhere between 1 to 7 million is the range that I see, which seems like a phenomenally large error of margin that we could potentially have. Yeah. One of the commentaries that I hear out there that I actually am a little concerned about, I'd love to get your take on, is, we've just delivered what was it, 600,000 units last year. We're on pace to do another, I think it's 400. This year, we're not going to really slow down until 26, 27. And, as you like to say a lot, the easiest thing in forecasting is supply, because you can just take the starts out 18 months and we see that it's going to fall off a cliff. Are you at all worried that this short-term glut of supply and absorption is going to help deliver a narrative that is oversupplied, so that would put rents in, and then people are going to start backing off? And by people, I mean not the developers. I mean more local city governments and those that actually empower the pipeline. Are we afraid that they're going to back off a little bit because of this short-term glut?
Yeah, that's a good question. I don't know that they're backing off, but what I would advise them, and I've tried to a little bit, is they need to double down. I don't think they're doing enough to keep it going. Right now, I think a lot of cities need to be aware, and policymakers need to be aware, that it's gotten harder to build apartments.
Yeah.
And, the economics have got a lot more challenging. Now, there are things the cities can do, as you know, whether it's, property tax abatements, it's, fee reductions from the building process. I mean, expedite the timeline. There's lots of things the cities can do to incentivize more construction. But I think that's the bigger risk, is that we don't take it seriously enough until it's, gotten too late again. And then, of course, it takes time to then ramp it back up.
Well, yeah. And I was listening to, yes, we are in a cyclical business for sure. And
absolutely.
We enjoyed the largest bull run cycle we've ever experienced for that 10 or so-ish year period. But correct me if I'm wrong, we're 2 years into the low part of this cycle from a rent perspective. And when I see that, some of these markets, I'll give you a plug for the rent roll. I was listening to the rent roll earlier today, and you were having the discussion at the time with Greg Willett where you were talking about absorption levels, and it was interesting. You really put it as basically net absorption relative to the supply that was coming in. And we think of these, drastically over quote unquote supplied markets here in Texas. Correct me if I'm wrong, Dallas had a positive absorption. I think the only Texas market that didn't was Austin, and it was not nearly as bad as I would have expected with how much they delivered.
Yeah. No, I mean, there's a ton of demand out there. That's one thing that, I've always kind of give some of the Wall Street analysts a hard time about this, because everybody talks about supply,
Right.
but not about demand. And the demand story has been absolutely phenomenal. Not just the actual absorption numbers, but also the demand drivers. Look at jobs and population growth. I was looking at some stats earlier on population growth in the last 5 years. Every single one of the top 15 markets is in the Sun Belt.
Yeah.
That's just where people are going. And so, if we weren't building the numbers of apartments that we were building, it would be a very different rent environment today.
So when you think about the Sun Belt being obviously the number one for a while from a supply perspective and absorption perspective, are there any geographies that you kind of look at and go, that one might be in trouble if we don't keep delivering the way we have been delivering?
Might be in trouble from
an undersupply.
Undersupply.
Yeah. That's what every builder wants to know. That's
where to go. Yeah. Well, I mean, there's really been no secrets, I think, anymore at the market level. I think, I think there are a few that I think one thing that'll be interesting over the next decade is there's going to be some of these smaller markets, we call them tertiary, secondary today, that become, more borderline primary markets. I think some of them are in the Midwest, or I see more institutional interest in markets like Columbus and Indianapolis and Kansas City. Obviously, they weren't really off the radar, but certainly they're more regional than national. And I think in the Sun Belt, you look at some markets that have had some really good, jobs and absorption numbers that are kind of growing on the radar a little bit. Oklahoma City has been one that no one really talks about, but it's growing really fast. Such smaller markets in South Carolina, secondary markets in Florida. There's a lot of markets I think out there that particularly for that are Northwest Arkansas that did not get as much supply, but have had really good demand stories.
Wow, Northwest Arkansas. That was not one I thought you were going to pull out. Not going to lie.
Some people think Fayetteville is like the next Austin, which I'm like, all right, maybe 50 years from now, but it's a cool spot.
Yeah, those are people who are diehard SEC folks. You said a trigger word in there that I got to come to and I got to pull on because it's one of my favorites to actually protect, institutional.
Yeah.
So you talk about that institutional appetite. Institutions again, institutional capital at this point in the broader public eye and the news are taking a little bit of a bloodbath. They're getting attacked pretty regularly. Why should the average everyday person care that the institutions actually want to invest in housing versus another portion of where they can invest? And I'd love us to dig into the fact that it's fungible. They don't have to be in housing.
Right. Well, first of all, I like to use institutional just because the other ones, like the headlines, like to say like hedge funds and Wall Street, private equity. It's like, I don't think some of the headline writers even know what those terms actually mean.
Or who's actually the money behind it.
And that as well.
Yeah.
They're not synonyms for each
Correct.
other necessarily either, and they're used that way interchangeably. But yeah, and I think one of the things, I mean, Andrew, you and I have talked a lot about this in the past that I think even people in our industry don't understand is that when you look at institutional capital, a lot of it is representing average everyday Americans. It's pension funds, retirement accounts, 401ks that could be exposed to REITs, et cetera. You have and other private and other institutional funds. That's a lot of them. I mean, pension funds represent. Oh yeah, everything's pension funds are these big bag giants. Well, who do you think the pension funds are actually like? Where's that money going?
Right.
It's going to people who are teachers, government employees, police officers, firefighters. Like that's their retirement.
I mean, you just named off two categories that both my parents fall in. And I've said this before on other podcasts, but like the couple of times I've had the opportunity to meet with the folks at CalPERS and CalSTRS, I've always thanked them for investing in that because I haven't had to worry about my parents when in their retirement because of the pension and what they were paid through that. So again, it's a big thing that I think that it's really easy to vilify, as you put it in the headlines. Wall Street's buying Main Street. Like you see that all the time. Especially even, I think it's actually the narrative I think is getting worse on the single family side versus the multifamily side. And it's hilarious because the investment on the single family side is a fraction of what's time, and it's a fraction of the marketplace itself.
Yeah, no, it's all narrative driven, and one of the things I find ironic too is like people have to, obviously everybody watching this knows this, but sometimes talking about institution for everybody else as if everybody else in multifamily are all mom and pops, and how many mom and pops can afford to buy a 250, 300 unit apartment building? We're talking like $50, $100 million checks. Like you're comparing, quote unquote institutional groups to, if it's a family, it's a ultra high net worth family office at best, right?
Yeah, I think where you might see the mom and pops are some of the operators. It's a lot easier to open up a third party management company and go run 1,500, 2,000 units as a mom and pop operation.
Absolutely.
Than it is to actually go buy and own 1,500 to 2,000 units as a mom and pop operation. That's a very well off mom and pop.
Absolutely. Is that as well as like the older kind of walk up buildings and old coastal cities? That's a whole different market as well, as you know.
Well, yeah, and it puts a good light. I didn't think I was going to go here, but I am. It puts a good light of another theme that I often hear you both talk about directly as well as not post about as often in the commentary in your posts. Would be the idea of that professionally managed, that professional investment grade property versus, the smaller multifamily that goes in.
Yeah, no, it's a good question. I think, let's just talk about rental housing more broadly. I mean, if you look at the census, U.S. Census tracks rental vacancy.
Right.
And those vacancy numbers are always higher. And for years, I used to wonder, why are they so much higher than what we see when you look at data from any of the major data providers for apartments? And they're always much lower. It doesn't matter which data source you use. And eventually, this is where LinkedIn came in handy. This is, I don't know how many years or months ago it was, but I was sharing, professionally managed occupancy data versus census. Why is it so much lower? And somebody who would be classified themselves as a mom and pop said, hey, as a more, passive investor, and they happen to be, I think, SFR, small multifamily, if I remember correctly, I have other things. I don't have the scale and the resources to immediately turn these units and get, have in-house maintenance teams. I have to schedule all of these things and I have to have the funds to do it. So it takes me a lot longer to turn a unit than somebody who's a professional manager. They have these resources in-house, so they have the right contractors on speed dial. They're able to do that. I mean, in our industry, especially in the professional manager world, turn time and average vacant days are KPIs.
Oh yeah, absolutely.
Those are things they actually look at.
For sure.
That are very important. And so it's not that I don't want to make a one or better than the other situation, but I think sometimes you'll forget. So like, if you think about there's a public benefit to the efficiency of a larger professionally managed group that can minimize downtime.
Well, yeah, and it minimizes the cost of the services and ultimately should minimize that impact on rent as well. And, it's interesting as you're saying that, I was thinking about, those of us who've been in the industry for a little bit, who've operated on a larger scale, we do look at that from that lens. Like when you first were talking about that difference between, the census data versus the, professionally managed data, I actually would have expected that the occupancy on the census data would have been higher.
Right.
Because the penalty from a financial perspective is so much stronger when you have 3 units than when you have 300 units. It's just easier to absorb. But
and just real quickly, that's always been the mindset, which is, hey, smaller operators care more about occupancy. Now, I think that's a gross oversimplification. Like we've sort of accepted that, but I'm not sure it's exactly true for part of this reason, which is that in the professionally managed world, you can't let a unit sit vacant very long. Like you've got to get it filled.
Yeah.
Now you may treat retention differently or whatever, but when it comes to occupancy, you got to get those units moving.
Well, and I go back to it may be more important from a theoretical perspective to the person who has 3 units, but their ability to actually fill it and their ability to actually turn it quickly.
Yes.
If you ask me to go do something that I only do 3 times a year, I'm gonna be a lot slower at it than if I do it 300 times a year on that. So it's a really, really interesting and really good point.
Yeah. No, you mentioned like the old marketing side is a whole aspect too as well. That takes time and yeah, I like how you put it. Like in theory, yeah, the occupancy should be more important on a smaller scale, but to execute it's not easy.
Yeah. And again, especially on the marketing side, there are just additional layers and levels that you can pull when you always have something on market versus when you have something on market 3 times a year.
Right.
Just this there. Okay, so let's shift the conversation just a little bit, because one of the questions I've been wanting to ask you is, obviously we have a new incoming administration. I'm not going to have you predict what all the housing policies are going to be moving forward, although that would be a fun podcast just by itself.
We'd lose a lot of audience though.
Yeah, we would, but the real hardcore nerds would stay with us. So what are your thoughts and what do you think the probability is around the future of the GSEs? Freddie and Fannie, are we going to see those actually end up being privatized or no?
I don't know, but I do think that's going to be a push. Obviously, that's something that was in the news that President Trump tried to at least talked about doing in the first term administration he had. First term did not obviously get it done. I think it's a lot more complicated than we probably all realize. Like on paper, it probably seems like a simple proposition. So I hate to be the guy who hedge on this. I would truly put it at 50-50. I think there's going to be a push to do it. Whether or not it could actually get done, I don't think it's a guarantee.
That's okay. You don't think it's a guarantee, but you do actually think there's a 50-50 shot he's going to try and push it through.
I think there'll be a conversation about actually pushing it through. Will it actually get there? I don't know. And while we're talking about the new administration too, I want to give a quick shout out, and I posted this on LinkedIn as well, that we have a very historical moment where for the first time in U.S. history, we have, assuming he's confirmed, we will have an actual industry veteran as the Secretary of Housing and Urban Development. Never before in history who've had somebody who've come from the private sector and actually built or operated housing or occupied that role. And so
shocking.
It's amazing. Yeah. We've had some public housing folks who've been in that role, but never until now. And so we have Scott Turner, Chief Visionary Officer for JPI, obviously a big apartment builder based in Dallas. And I've had the pleasure of meeting him a handful of times, and first-class individual, and certainly wish him the best. But that's a big moment.
Well, and for those who aren't familiar with him, all those things, yes. But I think one of the things that I think he brings back to the table, and I believe was a successful program, or relatively successful, was the entire concept of opportunity zone.
Yes.
He actually was one of the driving forces behind that, if I understand it correctly.
Yes. He did work in the first Trump administration and under Secretary Ben Carson, and his job was to basically go to communities across the country and help push adoption of opportunity zones, and that program undoubtedly was successful in spurring development in those areas.
Yeah. Indeed. Yeah, I saw an analysis of, I think it was Carl over at
Yeah,
RealPage.
Carl over at
Yeah, about the amount of new deliveries and that was either had been delivered or were still in the pipeline, actively under construction in opportunity zones, and it really did seem to make a huge difference.
Yeah, I see people debating this on like X and Twitter and or X/Twitter and whatnot, and I think a lot of times people say, oh, like it's just a handout or it doesn't really that would have get built anyway. It's like they don't know what they're talking about. Like this stuff does not get built. I mean, sure, some of it, yeah, but your people are targeting locations based on these opportunity zones because those deals can pencil out easier and it's an easier sell to investors. Like it's doing exactly what it's supposed to do. If you want something from a public standpoint, you incentivize it. So it's doing what it's supposed to do.
Well, and that's I think a part that, again, the general public doesn't necessarily think about when it comes to investing in housing. Is it's got to, we always say it has to pencil out. Well, a deal can pencil out and be profitable, but if it's not a better return than what they could get by going into equities or going into the office space or going into, data centers or now nuclear power plants, evidently we're going to start doing again, which actually I'm a big fan of, actually, to be perfectly honest. But it's just, there's that. It's not a, hey, where am I going to invest this money in multifamily? It's where am I going to invest this money, and is it going to be multifamily?
Yeah, and there's a real, this is obviously become a sensitive political topic, but I think there's a real risk in certain cities across the country. The focus has become more on, hey, these returns should be capped to inflation or whatever. Sure, that's fine, but you're disincentivizing development for the reasons you just mentioned, which is that in operation of this housing, not just the development, you could say we're excluding new developments, but then who wants to invest money into maintaining and upgrading these buildings as they age into obsolescence if that return isn't there? Especially like housing's hard.
Yeah.
Operating apartments is hard.
I know.
Yeah. It's gotten harder since COVID for a variety of reasons. And so to your point, Andrew, is if there's not, that return's not there, then you take pension funds. Like they have a obligation to the civil servants they represent to achieve certain returns. If they're not there, they're not contributing to housing production in the U.S.
Well, and when you think about those costs, there's the controllable and the uncontrollable, but especially what scares me more than anything now is the uncontrollable when you talk particularly around insurance.
Yeah.
Like, I look at, the absolute devastation that's happening, in the area I grew up in California right now. We're filming this in the second week of January. Most of Southern California, including where, I've got good friends who are out of their houses on fire right now. My wife asked me this morning, she's like, what's going to happen with insurance rates? And how does insurance actually work in a scenario like this where it's potentially $30 billion? And I'm like, there will be companies that go out of business. There will be companies that exit the state.
Yeah. And that was already starting.
Yeah. I mean, so to have, again, from a rent control perspective, to not be able to potentially recoup those costs, and you're going to go into a marketplace that has that type of back end exposure, that's not a risk a lot of asset managers, really a lot of investment managers, better way to put it, are going to be willing to take.
Well, and I tell people all the time, it's. I think this has gotten more attention since COVID. I mean, it used to be policy risk, sort of a footnote you put at the back of a disclosure. Now it's front and center. And you've heard me say this before, I'm sure others have as well, but policy risk, it's unpredictable and it's permanent. One city council vote can completely torpedo your investment.
Correct.
Supply risk, which everyone always worries about, it's predictable and it's temporary. So I'd rather sign up for supply risk all day long than sign up for policy risk.
I know it's a really, really good point. And we're seeing that on a number of different levels, on primarily the local level right now. But we saw the president in place for a few more days who proposed a 5% rent cap at one point. So you and I know that that's not the answer. That's the answer if you want to completely cut off the supply faucet. And we know what happens with prices when there's no supply and demand is only continuing to increase. What are some of the things that you think we can do as a society to help deliver more affordable housing? And again, by affordable, I'm talking about little a, not necessarily big A, thinking that workforce. What are some things that you've seen that are good ideas?
Yeah, I mean, I think that there's a lot we need to do. I mean, obviously, there's a lot of focus right now on zoning. It's crazy that the vast majority of areas zoned for multifamily tend to be very expensive real estate on major thoroughfares. That's where we, city planners, they look at a map and say, well, we don't want them in these neighborhoods or in single homes. We need to put them these
up against the busy street.
Busy streets.
They'll absorb the noise. They'll do all the things.
And then your land buyers are competing with, retail, entertainment groups that are looking at that same land. And I won't say office as much anymore, obviously, but really anything that can compete for that same plot of land. That's more expensive property. So zoning is part of it, but I think that it's not the only thing. I think a lot of the YIMBY crowd is very focused on zoning. I think it's only one part of the solution. The National Association of Home Builders and NMHC did a great study showing that regulatory costs are more than 40% of the construction costs, everything, the taxes and fees, and also just the time it takes to get things built. So I think there needs to be a close look at
what percentage was that they found?
About 40%.
Wow.
Of costs are in some way contributed or driven by regulations, taxes, fees, requirements of say stonework aesthetics on the building, like all of these things, parking requirements. I mean, here we are in Dallas, like north of us in Prosper, they've just outlawed garden apartments, and everything has to be ground floor retail and like structured parking. All that drives up the cost,
which is also a great way to have a lot of vacant retail in a town the size of Prosper.
Yeah, again,
or a lot of donut shops and a lot of nail salons.
That's what they're going to get, right? And a lot of this is kind of well intended. It's like, oh yeah, we all like how this looks, but it's like, guys, like you need to understand how housing works and how housing production works and what you're doing to the costs and therefore the rents. So all these things we address. And the last thing I point out too is I think we have to double down on public-private partnerships. I think programs that offer tax abatements, other incentives in exchange for a percentage of units with rent that's limited to incomes. I mean, that's what I would call essentially a need-based opt-in rent control program. Hey, if you want the benefit as a developer or an owner, you give the public a benefit. That way it's a win-win. Like it's rent control, but it's funded rent control.
Right.
And I think those are programs that can be, that have been and should continue to be very successful as well.
Yeah, I was going to say, I mean, I know some organizations that are doing those, and when they pencil them out at the end of the day, because of the tax, benefits on it, they actually pencil out better than a market rate deal because they are setting aside 20, 40, 60% of the property for, 80% of normalized income.
And this is what I think one of the dangers though right now is like, yes, you're right. But people hear that think, oh, they don't really need those. But what happened is, as you mentioned earlier, it's cyclical business. And so what happens is in the best of times, when things are booming, you didn't need those subsidy programs to justify construction because the rents were high enough, the costs were achievable. You could make that stuff work. Now it's so hard to build that any kind of subsidy helps maintain the construction pipeline, helps keep it going. You see a lot of market rate builders, including many that we know, that a much higher concentrate share of what they're building has some sort of tax subsidy program, attainable or affordable, attached to it, because that's what actually works. And now what's happening here in Texas is that's being criticized, saying, hey, they don't really need this. No, they do. Like if we didn't have that, there'd be even less construction right now than we have.
Well, yeah. And when you say they don't even need it, again, that money can go somewhere else. But without it, those lower income set aside units are not going to be built. So sure, you're then are also more exacerbating the problem and not having the more affordable, again, I keep clarifying and saying little a, apartments that are out there.
Yeah. No, and that supply has an impact on two levels, right? I mean, there's a filtering impact if you build new Class A construction that pulls higher income people out of the more moderate priced units, et cetera. But also, again, when you have those programs like PFC in Texas, where there are a certain set of units that are tied to rents tied to income, that makes a direct impact as well.
Yeah. So, and thank you for saying the PFC, because I was desperately trying to figure out what the acronym was for it, and I knew it. And I could.
We have these HFCs.
I kept coming through PVC. I'm like, no, Andrew, it's not a type of pipe.
But it's under attack in Texas, and it's something that the word focused on at Waymaker and Madera is that program, because we do believe in the cause, but also we think it's a win-win for communities and for investors. And I think we should. By the way, another thing we talk about is talking about policy stuff, Andrew, is like, I think we need to look at more as a society, more focused on win-wins as opposed to like this environment was like, hey,
yes,
if investors are winning, that means renters are losing. If renters are doing better, it's because investors are, it's not a tug of war contest.
Agreed.
Like it should be win-win, should be celebrated.
Well, again, that goes right back to the whole reframing of what is institutional money and who are the actual participants in it. And, how many times are these renters on site actually also unknowingly probably participants in the actual ownership of a deal as well. So, well, I think that was a good roundabout conversation to get to some solutions that we think can actually happen. The one thing I would tag on the end of this, though, is, you mentioned, that things are under pressure in Texas. And this is a soapbox I'm getting on pretty much all year at this point. And that's the whole idea of advocacy, and being that voice, not just on a national level, but on that local level, being that voice for, maybe you're not as far into it as I am, as getting truly into YIMBYism instead of NIMBYism, but be able to find out what the opportunities through your local apartment association are, find out what the opportunities are through your local buildings association. Because to your point, I think it was really well said, that threat really is not a national threat. It is a local threat as far as execution goes.
Yeah, absolutely. And I would say too, if you have vested interest in your communities, then, get to know your local leaders and the people who influence them, because you can't assume they know everything. A lot of times, like, people in our industry get frustrated because a city council did something or said something. But, if they aren't hearing from people saying, hey, here are the facts, here's what's going on, then you can't assume they're going to know it.
Well, and that city council member was, before being, elected, was probably own an insurance agency, or own a construction company, or own some other business, or was, an executive somewhere, or was a teacher, or all these types of things. They're not in our world of housing day in, day out, nor would I necessarily expect them to be. So to your point, it's being able to be that resource to help educate them, with facts versus opinions, and just being able to be that resource.
And I think, the vast majority are always willing to have a conversation and learn. And the places they don't want to even listen to you, then, that's where you just dust your feet off and move on to the next town.
Well, with that, we're going to dust our feet off and move to the next town, this one. So I think that it's pretty obvious people can find you on LinkedIn. How else can they find you? How else can people get in touch?
Well, they keep making new social media platforms. I have to get another one now. I'm just joined Blue Sky, but still on X/Twitter. Got the Rent Roll podcast on all the streaming platforms. And then I think it's probably enough.
Awesome. And I will say, I think you did a fantastic job with the Rent Roll podcast. Just having worked with you for as long as I did, I thought it was hilarious. You have the multifamily trivia question. And, for those who are on the IP team, way back in the day, we had Friday trivia thing. So it was nice to see that.
Well, I could never answer the pop culture one, so I made it more my wheelhouse.
Although I will say, you're starting to fall into the habit of taking the trivia from a post that you did in LinkedIn the week before. Like, the answer's somewhere buried in warning things. Yeah, you're definitely...
Yours are people who actually read them.
I appreciate you, Jay. Thanks for coming on.
Thanks for having me, Andrew.
Thank you for joining us on another episode of Unscripted, a LeaseLock podcast. If you have found the information in this episode, or any other for that matter, beneficial in any way, the best way to support the work we do is to like and subscribe to the channel. That way, you'll be sure to never miss a new episode when they drop. Also, sharing your takeaways in the comments or on the social media platform of your choosing, mine happens to be LinkedIn, is also a great way to help us get the message out. Additionally, if you would like to suggest a guest or perhaps be a guest on Unscripted, please head over to leaselock.com/unscripted, where at the bottom of the page you'll find a guest submission form. We would love to help you tell your story. Until next time, make it a great day.